You have $1 to save for retirement. The IRS offers you 2 doors. Behind door 1, pay the tax now and never pay it again. Behind door 2, skip the tax now and settle up decades later. Same dollar, same fund. Pick the wrong door, and over 30 years the gap can cost you as much as a new car, enough to sting, handed to the IRS for nothing. Most people pick by vibes. Let's actually run the math. Here's the punchline before we climb. This is one bet. Your tax rate today versus your tax rate in retirement. If your rate will be lower later, traditional wins. If it'll be higher later, Roth wins. If they're equal, it's a mathematical tie. And this isn't advice, just the math. Run your own numbers before you move a dollar. But there's one asymmetry buried in the tax code that tilts the whole table, and almost nobody runs it. That's the rung we're climbing to. Rung 1. You earn a normal income and you're in the 22% bracket. You put $1 into a traditional account. That dollar was going to be taxed at 22%, the top slice of your income. Instead, it slides in untaxed. You just saved 22 cents, right off the top. End of rung 1. Traditional just saved you 22%. Roth saved you 0% today. Feels like a blowout. It isn't. Rung 2. And here's the trick. When you deducted, you saved at your marginal rate, the very top of your income. But when you withdraw in retirement, the money refills your brackets from the bottom. Watch. It's 2026. You're single. You pull $70,000 from that traditional account. The first $16,100 comes out tax-free. That's the standard deduction. The next $12,400 is taxed at 10%. The chunk after that, at 12%. Only a thin sliver ever reaches 22. Add it up, about $6,570 in tax on $70,000. That's an effective rate of 9.4%. You deducted at 22. You pay back at 9. End of rung 2. That 12-point gap is the entire traditional edge, and it's the number nobody runs. Rung 3. Now watch the ladder flip, because Roth wins decisively in a few very real cases. 1. You're young and in the 12% bracket right now. You'll almost certainly retire in a higher effective bracket, so pay the cheap 12% today and never pay again. 2. You think future tax rates go up, a perfectly defensible bet. 3. The sneaky one. Required minimum distributions. Starting at age 73, the IRS forces money out of your traditional accounts whether you need it or not. A big pre-tax balance can shove you into a higher bracket in your 70s, spike your Medicare premiums, and make more of your Social Security taxable. Roth has no required minimum distributions. End of rung 3. If later you is taxed even 5 points harder than today you, Roth wins. Rung 4, the top. What if today's rate and tomorrow's rate are exactly equal? Then it's a tie, identical after-tax dollars, as long as you actually invest the tax savings the traditional hands you back. And that's the catch most people miss. If you just spend that refund, Roth quietly forces you to save more. So when you genuinely can't predict your future bracket, and who really can, you hedge. You fund both. Tax diversification, a Roth bucket and a traditional bucket. So in retirement, you choose each year which one to tap to control your bracket. Now, the internet's favorite line. Roth is always better. The growth is tax-free. Said that way, it's wrong. The growth is tax-advantaged in both accounts. The only thing that decides the winner is the rate on the dollar going in versus the rate coming out. Roth's real, separate superpowers are no RMDs and tax flexibility, not a magic growth boost. Anyone who tells you one door always wins hasn't run the brackets. So here's the one thing to remember. Roth versus traditional isn't a personality test. It's a bracket bet. High earner now, likely lower later? Lean traditional and pocket that effective rate gap. Low bracket now, or a fat pre-tax balance heading for RMDs. Lean Roth. Genuinely unsure? On both, and keep the optionality. Run the 2 numbers, your rate now, your rate later, and the door picks itself. That's tonight's working theory, a new one every night at 7. This isn't financial advice. It's public math, so run your own numbers. And if it's real money, talk to a tax professional. Tell me in the comments, are you team Roth, team traditional, or team both? I read every one.